There is a number sitting on a balance sheet in Wolfsburg, Germany. It is not a number most people will ever see. It has no headline of its own, and yet, depending on which way it moves over the next 18 months, it could decide whether the European Union, a bloc of 450 million people and 27 governments, holds together as a single economic project, or begins, quietly, to come apart. That number is Volkswagen's restructuring bill. The company has already committed to 50,000 job cuts in Germany by 2030, a target raised in March 2026 from the 35,000 originally agreed with unions in late 2024. German business media have also reported, citing internal documents, a far larger plan under discussion, one that could affect up to 100,000 jobs worldwide, with 4 German factories under review for possible closure and planned investment cut by as much as 15%. On July 9, 2026, Volkswagen's own supervisory board took up that larger plan, and Labour representatives on the board blocked it. Even at the confirmed numbers alone, this is not simply a corporate story. One company, one bad quarter, one CEO under pressure. Volkswagen supports a supply chain that stretches into Poland, the Czech Republic, Slovakia, Hungary, and Spain. Pull one thread in Wolfsburg, and factories 2,000 kilometers away feel it within weeks. This is the paradox we're going to sit with for the next 50 minutes. Germany built the most successful export economy in modern European history by becoming indispensable. The engineering core, the industrial anchor, the one country every other European economy quietly depended on. But the same machine that made Germany indispensable to Europe has stalled. 2 years of recession behind it. Industrial output down roughly 15% from its peak. Unemployment climbing toward levels not seen in over a decade. And here is the part almost nobody is asking out loud. What happens to the rest of Europe when its anchor economy stops pulling its weight? But to understand why this matters, you first need to see exactly where it sits on the map. To understand why Germany's stumble threatens the whole European project, you have to understand what Germany actually is inside that project. Not politically, economically. Germany is the European Union's single largest economy, generating roughly a quarter of the entire bloc's output. That is not a marginal share. That is the difference between the EU functioning as a coordinated economic bloc and the EU functioning as 27 competing economies that happen to share a currency. For nearly 2 decades, the model worked like this. Germany manufactured high-value goods, cars, machine tools, industrial chemicals, precision engineering, and exported them to the world, especially to China and the United States. It imported cheap energy, first from Russian pipelines, to keep that manufacturing base competitive, and it exported capital and demand back into the rest of the Eurozone, buying parts from Poland, components from the Czech Republic, and steel from Italy. Germany wasn't just an economy, it was the engine block for a much larger European machine. That model came with a second pillar, fiscal discipline. In 2009, Germany wrote a rule directly into its constitution, the debt brake, limiting new government borrowing to a razor-thin 0.35% of GDP. For over a decade, that discipline was treated as a national virtue. Roads, bridges and railways aged without major reinvestment, but the budget stayed close to balanced, and German government debt became the benchmark against which the rest of the Eurozone was measured. The machine ran lean, and everyone else in Europe borrowed a little cheaper because of it. Then, two shocks hit the machine itself, back to back. First, in 2022, the loss of cheap Russian pipeline gas forced German industry, chemicals, steel, glass, ceramics, all deeply energy-intensive, to absorb some of the highest energy costs of any advanced economy on Earth. Second, starting in March 2026, a new conflict in the Middle East pushed oil and gas prices up again, just as Germany's industrial base was beginning, tentatively, to stabilize. The country has been hit by two separate energy shocks in under 4 years, a burden almost no other G7 economy has had to absorb twice. The erosion, though, didn't start in 2026. It was already visible years earlier. By 2023, German industrial production sat 6.5% below its pre-pandemic level, and the country's trade surplus, the gap between what it exports and what it imports, long the clearest signal of German economic strength, had shrunk from 175 billion euros in 2021 to 120 billion euros in 2023, a drop of more than 30% in 2 years. This was the picture before the second energy shock ever hit. The 2026 crisis didn't create German industrial weakness, it landed on top of it. Individual companies make the pattern concrete. BASF, the world's largest chemical producer, announced in 2023 that it would permanently cut energy consumption at its flagship Ludwigshafen site by 10% and accelerate new investment outside Europe entirely. Not a temporary belt-tightening, but a long-term bet that German energy costs would not come back down. Its own reasoning would prove to be widely shared. Nearly 40% of the members of Germany's Machinery Industry Association say they are actively relocating production capacity outside the European Union. Layered on top of expensive energy is a second, quieter pressure: China. Chinese manufacturers have spent the last decade moving up the value chain, no longer just cheap assembly, but direct competitors in machinery, industrial components, and increasingly electric vehicles, where German firms once held an almost unchallenged premium position. That competition is eroding German market share, both inside China, once its most reliable growth market, and in third countries, where German and Chinese exporters compete head-to-head on price and quality alike. The result of all of this shows up in the labour market. German industrial production sits roughly 15% below its pre-crisis peak. The economy contracted for 2 consecutive years before eking out just 0.2% growth in 2025. Technically an expansion, but statistically closer to standing still. Unemployment has climbed toward 3 million people, a level not seen in over a decade, driven overwhelmingly by losses in manufacturing. And at the center of that manufacturing pain sits the industry that has defined German identity for a century: automobiles. Volkswagen, Europe's largest automaker, has committed to 50,000 job cuts in Germany by 2030, up from 35,000 agreed with unions in late 2024. German media have reported a far larger plan, up to 4 factory closures, that Volkswagen's supervisory board took up on July 9, 2026, and that Labour representatives blocked. Across the wider German auto and supplier sector, more than 100,000 jobs have already disappeared since 2019, with industry associations forecasting a further 125,000 losses by 2035. This is not a single company's bad year. This is the retreat of the sector that for a generation was Germany's core argument for why it deserved to sit at the center of the European economy. None of this is happening in isolation. Every one of these factories sits inside a supply chain that reaches across borders, into Polish component plants, Czech assembly lines, Slovak parts manufacturers, Hungarian battery plants. When German industrial demand contracts, it does not stay contained inside German borders. It travels. And that geography hides a fragility almost nobody talks about, until it breaks. Here is what a German recession actually looks like on the ground. And it starts nowhere near Berlin. It starts with a single component, a wiring harness. It's extruded and assembled in a plant in Slovakia. It travels to a factory in the Czech Republic, where it's built into an engine compartment module. From there it moves to Hungary, where battery management parts are added. Then it goes back to Slovakia for final vehicle assembly. Only then does the finished car cross into Germany, to a dealership, or onto a ship bound for the United States or China. That one car crossed 4 borders before it was finished. This is not an unusual case. It is the standard operating model of European manufacturing. And it means that when demand for German-branded vehicles falls, the shock doesn't stay in Germany. It runs backward through every one of those border crossings in reverse in a matter of weeks. Reveal 1. The automotive dependency layer. In Slovakia, the automotive sector generates around 1/8 of the entire country's GDP and accounts for more than 40% of both industrial output and total exports, a concentration built almost entirely around supplying German-based manufacturers. In the Czech Republic, cars and car parts make up roughly 1/4 of industrial output and more than 1/3 of all Czech exports across every sector cross into German hands. These aren't trading partners in the ordinary sense. Slovakia and Czechia function economically as extensions of the German industrial floor, assembly stations that happen to sit across an international border. So when Volkswagen confirms tens of thousands of job cuts, and when German media report an even larger restructuring still under internal review, the honest translation is this: it's not only a German job story, it's a Central European job story wearing a German name tag. In 2023 alone, trade between Germany and its Central and Eastern European supply base topped $522 billion, more than Germany trades with any single other partner on Earth, including the United States or China. That is the scale of the machine running below capacity. Reveal 2. The energy transmission layer. Germany's high energy costs don't stay contained inside German factories either. When German industrial energy costs rise, German manufacturers do one of 2 things. They pass the cost downstream to suppliers by squeezing purchase prices, or they relocate production entirely. Both are already happening. German chemical giant BASF has been shifting new investment out of Europe and cutting energy consumption at its flagship domestic site for several years running. Nearly 40% of the members of Germany's own Machinery Industry Association say they are actively moving production capacity outside the European Union. The German government treats this as urgent enough to intervene directly. In April 2026, Berlin secured European Commission approval for a €3.8 billion industrial electricity subsidy, capping prices for energy-intensive firms at roughly 5 cents per kilowatt-hour on up to half their annual consumption, backdated to the start of the year. That is not a routine policy adjustment. That is a government stepping in to artificially hold down the price of electricity for its own manufacturers, because the market price alone was pushing them out of the country. And even with that subsidy in place, every plant that still leaves doesn't just cost German jobs, It removes a customer from the Czech, Slovak, and Polish suppliers who were building parts for that plant. The order simply stops arriving. Reveal 3. The global competitiveness layer. And this is where the problem stops being about Europe at all. According to the International Energy Agency's own 2026 analysis, industrial electricity prices across the European Union in 2025 averaged more than double those in the United States, and nearly 50% above prices in China, a gap that has held steady since 2024, meaning it isn't a temporary spike from the energy shock. It's structural. German industrial electricity specifically runs at roughly twice the American price and sits well above even France's, where nuclear power supplies 70% of the grid and insulates French industry from the same volatility. Germany isn't just losing a regional competition with its own supply chain. It's competing globally against American and Chinese manufacturers who pay a fraction of what a German factory pays to keep the lights on. And no domestic subsidy program, however large, closes a permanent structural gap of that size. It can only slow how fast the gap does its damage. Reveal 4. The credit and insolvency layer. And this is where the pressure stops being theoretical. Large German companies, those with annual revenue above 10 million euros, filed for insolvency 471 times in 2025, a 25% jump from the year before, which had itself risen 35% over 2023. Restructuring analysts expect a further 15 to 20% increase in 2026. And industry analysts tracking the broader pattern point to where the pressure concentrates hardest: small and medium-sized firms in the chemical and automotive supply sectors. The same companies sitting inside the cross-border production chains that run through Slovakia, Czechia, and Hungary. When one of those suppliers goes under, it doesn't just disappear from a balance sheet. It breaks a link in a chain that a factory in Bratislava or Brno was depending on to receive its next shipment on time. Reveal 5. The fiscal transmission layer. And this is where it stops being a factory story and becomes a European story. For decades, Germany's reputation for fiscal discipline, the constitutionally enshrined debt brake, limiting new borrowing to a razor-thin margin, made German government debt the safest asset in the Eurozone. Safer German debt meant lower borrowing costs for Germany, which acted as a kind of gravitational anchor for the entire currency union. In 2025, Germany broke with that identity. Facing a defense spending mandate and crumbling domestic infrastructure, the government pushed through a constitutional amendment exempting defense spending above 1% of GDP from the debt brake entirely, alongside a €500 billion infrastructure fund spread across 12 years. Germany's debt to GDP ratio, sitting around 63%, is on a rising path, with the overall fiscal deficit expected to widen toward 4% of GDP by 2027. Here is the mechanism that matters. As long as Germany's own fiscal position looked untouchable, its rising borrowing didn't spook markets. But Germany is issuing this new debt into an economy that just posted 2 years of recession, an industrial sector shedding jobs and filing for insolvency at an accelerating rate, and a demographic structure where the old age dependency ratio is projected to approach 50 per 100 working age adults by 2050. If German debt itself starts trading like an economy under stress, rather than an economy of last resort, the anchor for every other Eurozone bond loses its mooring. Reveal 6. The demographic layer beneath all of it. Germany's working-age population peaked around the year 2000 at roughly 55 million people and has since shrunk by more than 3 million. The federal subsidy required just to keep the state pension system solvent has climbed from 100 billion euros in 2022 toward a budgeted 115 billion euros in 2025. Money that competes directly with the infrastructure and defense spending being financed through new debt, and with the electricity subsidies propping up German industry. This is not a cycle that reverses itself in a year or two. It is a structural current running against Germany for the next 2 decades, regardless of which government is in power in Berlin. Layer these 6 mechanisms on top of each other. The auto supply chain running through 4 borders before a single car is finished. Energy costs so high globally that the state subsidizes electricity just to keep factories from leaving. A credit system where insolvencies are climbing fastest, exactly where the cross-border supply chains are thickest. A fiscal anchor under its own strain, and a demographic drag with no expiration date. And you start to see why economists who study the Eurozone don't talk about a German problem. They talk about a German-shaped hole opening up in the middle of the European architecture. But the real story isn't what happens on the map. It's what happens to the money. Every mechanism we just walked through, the supply chains, the energy costs, the insolvencies, the bond spreads, the demographics, ultimately answers one question: where does the money go next? And the answer is starting to take shape in several directions at once. Some of that money is leaving Europe entirely. Some of it is simply moving to different addresses inside Europe. And some of it is exposing a fragility that has nothing to do with Germany directly, but everything to do with what Germany used to guarantee. Who gains? Part 1. China. For 20 years, German automakers sold combustion engine excellence to the world, and China bought a great deal of it. That relationship is inverting. Chinese manufacturers have spent the past decade moving up the value chain, no longer competing only on cheap assembly, but directly on engineering, on precision components, and increasingly on electric vehicles, a category where German firms once held an almost unchallenged premium position. Chinese brands offer comparable quality at a lower price, and they are capturing market share both inside China, once Germany's most reliable growth market, and in third countries that used to belong to Volkswagen, Mercedes, and BMW, almost by default. This is not simply China getting richer. It is China capturing, segment by segment, the exact export categories that finance Germany's post-war economic model. Every sale a Chinese EV brand makes in a market Germany used to dominate is a sale that no longer flows back through Wolfsburg, and therefore no longer flows back through the supplier plants in Slovakia and the Czech Republic that depend on German orders to stay in business. Who gains? Part 2. The United States, at least in the short term. Washington's tariffs on European vehicles and parts, announced at 25%, later negotiated down to roughly 15%, remain well above the pre-trade war baseline of about 2.5%. That is a permanent tax on German exports to their second largest market, and it does 2 things simultaneously. It pushes some German and European manufacturers to consider relocating final assembly into the United States to avoid the tariff altogether, taking investment and jobs with them. And it reinforces a broader pattern that shows up whenever European political and fiscal risk rises. Capital tends to drift toward dollar-denominated assets, simply because the alternative, a currency union with a wobbling anchor economy and a second major member under fiscal strain, looks less certain than it did a few years ago. Money that might have financed a new battery plant in Hungary starts asking itself at the margin whether it would rather sit in US treasuries instead. This is not a dramatic, single-day capital flight. It is a slow reweighting of where global investors feel safest, and slow reweighting is exactly the kind of pressure that shows up first in bond yields, not headlines. Who gains? Part 3. And this one surprises people. Spain. While Germany and France dominate the headlines, Spain has quietly become the outperformer among the Eurozone's 4 largest economies. Spanish GDP grew 2.7% year-on-year in the first quarter of 2026, compared with just 0.3% for Germany and 1.1% for France. Spanish productivity is rising faster than in Germany, France, or Italy. And Spain is on track to be the only one of the Eurozone's 4 biggest economies actually reducing its debt-to-GDP ratio over the next several years, even as Germany's and France's both climb. Part of the explanation is structural: a construction and services-led recovery, strong labour market gains, sustained inward migration expanding the workforce at exactly the moment Germany's is shrinking. But part of it is a direct consequence of the choice we've spent this video examining. Spain has largely opted out of the defence spending build-up, driving deficits higher in Berlin and Paris, preserving fiscal credibility with bond markets precisely by not chasing the same rearmament commitments. Spanish sovereign bond spreads have widened too, in step with the broader energy shock, but far less than peers, and investors have kept their confidence in Spain's underlying position, even as that confidence eroded elsewhere. That is a striking reversal of Eurozone history. For most of the currency union's existence, Spain was the periphery and Germany was the core. On some of the metrics that matter most to bond investors, that hierarchy is starting to blur. Who loses beyond Germany itself? France. And this is the geo-economic twist that turns a German story into a European one. For 15 years, French government debt traded as a relative safe haven, precisely because investors could compare it favourably to Italy, Greece and Spain, the Eurozone's traditional risk cases. But France has spent that advantage. Its public debt has climbed toward 118% of GDP. Its budget deficit has run above 5% of GDP, well above the EU's own 3% reference ceiling, and 3 prime ministers cycled through in little more than a year amid parliamentary deadlock over how to close the gap. Credit rating agencies have taken notice. Fitch and S&P both downgraded French sovereign debt in the second half of 2025, and Moody's shifted its outlook to negative. The spread between French and German 10-year bond yields, the market's plainest gauge of relative confidence, has widened enough that at points French borrowing costs have exceeded Italy's, a reversal that would have been almost unthinkable a decade ago, when Italian debt was the Eurozone's textbook risk case and French debt was treated as core, dependable paper. Here is why Germany's slowdown makes France's problem worse instead of better. France's entire debt strategy for the past 15 years rested on one comparison. French debt looks safe next to Italian or Greek debt, and it looks almost as safe as German debt. Take away a strong, stable Germany from that equation, and the comparison France has relied on weakens from both sides at once. Investors don't just worry about France in isolation anymore. They start pricing German bunds with a slightly higher risk premium too, which means the entire Eurozone yield curve can drift upward together, even for countries that have done nothing themselves to deserve it. That is precisely the exposure built into a currency union without full fiscal union. One member's weakness raises the cost of borrowing for everyone using the same currency, because markets price risk relative to the group's strongest member, and the strongest member just got weaker. There is a backstop, in theory. The European Central Bank holds a tool called the Transmission Protection Instrument, created in 2022, which allows it to buy the bonds of a struggling member state to stop borrowing costs from spiraling out of control. But that tool was designed as an emergency valve for an isolated, contained crisis. A single member state under acute stress, with the rest of the currency union stable around it. It was not designed for a scenario where Germany, the anchor itself, is simultaneously absorbing an industrial slowdown, rising insolvencies, and a widening fiscal deficit, while France, the second largest economy in the bloc, is running one of its largest peacetime deficits and cycling through governments. If both economies are under strain in overlapping ways, the ECB faces a genuinely harder choice than it faced during the sovereign debt crisis of the early 2010s. Intervene aggressively and risk being seen as underwriting the fiscal choices of the currency union's two largest members indefinitely, or hold back and risk the kind of confidence crisis in Eurozone debt that the currency union has not faced since Greece, Portugal, and Ireland needed rescuing more than a decade ago. The alternative routes are already being tested, and they run through Central Europe. Poland has spent the last decade quietly building the largest, most diversified economy in Central Europe, one increasingly less dependent on any single German customer, with its own growing domestic consumption base and a defense spending boom of its own tied to the war on its eastern border. Polish exporters have been gaining market share inside Germany itself, including in fast-growing categories like electric vehicle batteries, where Polish firms hold more than a quarter of the German import market in that specific product line, precisely as German producers lose ground in the broader European market to Chinese competition. Slovakia and the Czech Republic have fewer options. Their economies were built, plant by plant, around German demand. Assembly lines, supplier contracts, and industrial parks all shaped over 3 decades to serve German manufacturers specifically. The structural dependency leaves little room for quick diversification. Unwinding that concentration and rebuilding it around new customers would take years, not quarters, no matter how urgently local governments might want it.
What all of this adds up to is a redistribution of power, not just wealth. For a quarter century, Germany's economic weight gave it outsized influence inside EU institutions, in setting fiscal rules, in shaping trade policy toward China and the United States, in deciding how much collective European money goes toward defense spending and how much toward cohesion funds for poorer member states. That influence was earned by being the continent's most reliable paymaster and its most competitive exporter simultaneously. A Germany that needs debt brake exceptions and industrial electricity subsidies just to keep its own factories running. That is watching its flagship industry shed jobs and file for insolvency at an accelerating pace, and that can no longer act as the fiscal anchor, reassuring markets about France and Italy, is a Germany with measurably less leverage to insist that the rest of Europe follow its rules. And the fact that Spain, for so long treated as Europe's fiscal periphery, is the Eurozone's most stable large economy on some of the metrics that matter most, only underlines how far the old hierarchy has shifted. That vacuum does not stay empty. It gets filled by whichever government still has fiscal room and political will to act.
And that is not obviously any single traditional European power. It is, increasingly, decisions made in Beijing about where to sell electric vehicles, decisions made in Washington about tariff schedules, and quiet fiscal outperformance in Madrid that are shaping outcomes for factory workers in Slovakia and bondholders in Paris more directly than decisions made in Berlin. Europe's largest economy built the rules of the game for a generation. It is, for the first time in decades, playing partly by rules written elsewhere. Which leaves us with one final question, the one that changes how you'll read the news going forward. Go back to where we started, a number on a balance sheet in Wolfsburg. Confirmed cuts already, running into the tens of thousands, with a far larger restructuring reportedly still on the table. On its own, still just a corporate story. But you know what that number actually touches? A wiring harness plant in Slovakia, sitting inside a sector that alone makes up nearly half the country's industrial output. A Czech supplier network sending more than a third of everything it makes across the German border. A credit system where large company insolvencies climbed 25% in a single year, while the broader wave of failures concentrated hardest in the chemical and automotive supply sectors, most tightly wired into that cross-border chain. A French sovereign bond market that leaned on German strength as its own safety net, and is finding that net thinner than it assumed. A European central bank holding one emergency tool built for one country at a time, watching two of the currency union's three largest economies lean toward it at once. And on the other side of the ledger, a Spain that chose not to chase the same defense build-up and is outgrowing Germany, France, and Italy alike. This is the answer to the question we opened with. Germany's economic collapse could break Europe, not because Germany is the only economy that matters, but because Germany was never just an economy inside the European Union. It was the mechanism holding the others together. It was the cheapest borrower, so everyone else's borrowing costs stayed low. It was the biggest buyer, so a dozen smaller economies built their industrial base around supplying it. It was the fiscal example, so investors gave France, Italy, and Spain the benefit of the doubt for 2 decades longer than their own numbers justified. Remove the anchor, and you don't just lose Germany's growth, you lose the reference point that made every other country's risk look smaller than it actually was. But it's worth being precise about what removing the anchor actually means in practice, because the honest answer isn't collapse, it's something slower and more contested. 2 paths running in parallel, and it isn't yet settled which one wins. The optimistic path is already funded and partly underway. Germany's own Economic Research Institute, DIW Berlin, forecasts GDP growth of 1.0% in 2026 and 1.4% in 2027, an upturn the institute attributes directly to the fiscal package, as roads, railways, digital networks, and energy grids that were left to decay under 2 decades of fiscal restraint finally get rebuilt. The OECD's own forecast, updated in June 2026 to reflect the energy shock, sits in a more cautious range, 0.3% growth in 2025, 0.7%
in 2026 and 1.1% in 2027. If that trajectory holds, Germany doesn't need to fully reverse its industrial decline. It needs the fiscal stimulus to arrive fast enough and broadly enough to offset the drag from energy costs, global competition, and an aging workforce, buying the country a decade to restructure its industrial base around a different energy reality rather than trying to outcompete it on the old terms. The less optimistic path is about execution, not ambition, and it's already visible in the data. The European Commission's own Spring 2026 forecast noted that Germany's fiscal deficit stayed flat at 2.7% of GDP in 2025, unchanged from 2024, specifically because spending from the new off-budget funds came in lower than planned due to administrative delays, a late-adopted federal budget, and postponed transfers to Germany's regional states. In other words, the money has been approved. It has not yet reliably been spent. A €500 billion infrastructure fund only raises GDP if it actually flows into cranes, cables, and concrete on the timeline the models assume. And Germany's own recent history, famously slow permitting, famously cautious federal bureaucracy, is precisely the risk factor economists flag when they discuss whether this fiscal expansion will arrive in time to matter or arrive a few years too late after the supply chains in Slovakia and the Czech Republic have already found other customers, and the capital that might have rebuilt German industry has already settled into Spanish construction, Polish batteries, or American treasuries instead. Even setting that risk aside, the industrial electricity gap alone is a reminder of the limits of any purely fiscal fix. Money can subsidize a factory's power bill, but it cannot, on its own, rewrite the deeper reality that German industry competes against American and Chinese rivals, paying a fraction of what it pays for the same kilowatt hour.
Some economists studying this moment reach for historical parallels, and it's worth being honest about where those comparisons hold and where they break down. The instinct is to compare Germany to Japan's so-called lost decades, years of near-zero growth following an asset bubble. But that parallel is imprecise. Japan's stagnation came with deflation and followed a financial bubble bursting, while Germany's slowdown is driven by a structural shift in global energy and trade, not a collapsed asset market. A closer, if still imperfect, comparison some analysts draw is to Britain after 1979, a manufacturing economy forced to deindustrialize faster than its service sector could absorb the shock, a process that took the better part of a decade before London's financial sector grew large enough to fill the gap. The open question for Germany is whether it has an equivalent sector waiting in the wings, and it isn't obvious that it does. That is the real tension sitting underneath the headline of this video. It is not a question of whether Germany collapses in some dramatic single-event sense. That was never the likely outcome, and treating it as inevitable would be exactly the kind of empty alarmism this channel doesn't traffic in. The real question is a race between two clocks. How fast Germany's fiscal machine can actually convert €500 billion of approved spending into functioning factories, ports, and grids, against how fast the rest of Europe adapts to a Germany
that can no longer be counted on as the automatic anchor it was for 25 years. Central European supply chains rewiring toward new customers. France searching for a fiscal path that doesn't depend on Berlin's stability. Spain building a growth model that never needed Germany's playbook in the first place. None of that reverses if Germany's recovery eventually arrives. It just means Europe's center of gravity has already started shifting elsewhere by the time it does. None of this means the European Union is about to dissolve. Institutions built over 70 years don't fail in 18 months, and Europe has absorbed shocks before: a financial crisis, a sovereign debt crisis, a pandemic, a war on its border, and adapted each time. But adaptation has a cost, and that cost has historically been paid in the currency of power. Less European leverage in trade talks with Washington and Beijing, slower and more contested decisions on defense spending precisely when the continent's security environment demands the opposite, and a widening gap between the countries that can still borrow cheaply and the ones that cannot. The strategic lesson is this: for a generation, the German economy and European stability were treated as two ways of describing the same thing. That assumption is being tested in real time, in factory closures in Lower Saxony, in bond spreads in Paris, in battery plants courting new customers in Warsaw, in a construction boom in Madrid that owes nothing to Berlin's fiscal choices. Whoever understands that Germany's stumble is not a national story, but a structural one, a stress test running simultaneously through supply chains, sovereign debt markets, demographic math, a genuine global energy cost disadvantage, and a race against Germany's own bureaucracy to spend the money it has already approved, will understand the next decade of European politics before the headlines catch up. That's exactly the kind of connection we trace on this channel, the line between a factory floor and a continent's fate. If you want to understand where power, maps, and money collide before it becomes the story everyone else is trying to catch up on, subscribe to Meridian Theory and turn on notifications.